Yeah, so once again, Mario from the Steele Group here with Cliff Steele. Another one of our kind of presentations where we delve into a few different topics. Today's topic is has been quite of interest for some time for a lot of individuals because of what you see in the news about AI, artificial intelligence. So we thought we'd bring someone in that's part of a team working heavily on portfolios that right now are focusing on AI, but they focus on a lot of other items in the investment markets and things of sort. So on the screen, you're going to see an individual by the name of Kabi that works with a firm and partners with them. They're out of Australia, actually, Munro, and he's out of their Toronto office, which helps liaison between offices like ours and their investment strategy to kind of help through the gaps and kind of understand their individual mandates, how they work. But his background is not only through Munro, but he's also worked at BMO, Private Investment Council out of Toronto. So he's been in Canada for the majority of your career, from my understanding. Has an extensive background on this space. So maybe without further ado, is there anything you want to fill in on yourself, or maybe just give a bit of a background on the company and kind of where they kind of cut their teeth, where they came from, and kind of their approach to the world when it comes to investing?
Absolutely. And first of all, thank you for having me here. I really do appreciate the time. And to your point, Mario, yes, I am based entirely in Canada. My entire career is based out of Toronto, actually. We do work for an Australian company, so I am working on the accent. I'll do better next time. But with that aside, yes, so Munro Partners basically was a firm established in 2016. However, our track record of investing the way we do, the way we're going to talk about today, has existed actually for the better part of 2 decades. And maybe this is a good time to segue into our slide deck here. Just let me know if you can see the slides there.
Yeah, it looks like it's working. Perfect.
Perfect. So look, about Munro, quick history on the firm itself. As I mentioned, we were established in 2016 in Melbourne, Australia. Our chief investment officer, Nick Griffin, and I will say a little bit biased, but I will say one of the greatest, growth investors, one of the most forward-looking guys I've ever met in equity markets. He's established this track record of going all the way back to 2005, when he first started looking at things like the internet and, of course, things like the smartphone, and realized that there was an investment case to be made in focusing exclusively on the secular trends or the shifts in society that were changing the way that consumers were interacting with the world. And that's really where our investment process comes in from, and we'll talk about that in a second. Now, what you're seeing on the screen here, we've managed to do 19, actually, as of the end of June. This is about almost 20% per annum over the last 5+ years that we've run this strategy that we're going to focus on in today's conversation, and that is the CI Munro Global Growth Equity Fund. This is a long-only fund, and we'll talk more about what that looks like in a second. We run just shy of $5 billion in assets under management, but what I always say to Canadian investors is that the bulk of that money, despite us being an Australian-based shop, the bulk of that money that we manage is for Canadian clients, more than half of that money, actually. And that's why you're here listening to somebody that doesn't come with that Australian accent, because we pride ourselves in providing that transparency and access to our investors here in Canada. And 30 people in the firm, almost half of that is our investment team, all based out of Melbourne. How you can access our investment philosophy and process and way of thinking, which we'll get into in a second. It's really simple. 3 products on our Canadian shelf. We've sort of contextualized it for you on this slide to show you, how we break things up in terms of our risk level or the appropriateness for various clients. On the far left, this is the strategy that has that near 2-decade track record and has been in Canada for over 6 years now, and is actually one of Canada's largest, what we call liquid alternatives. And what that is just a fancy word for saying that we are a sort of a hedge fund strategy wrapped up in a structure that is easily accessible to retail clients. And really what this strategy does, it tries to invest on the long side, so buying companies that are structural growth champions. We'll define what that is in a second. And then also we can take short bets or bet against companies that are basically the structural losers of those same trends, 30 to 50 positions. And within that, what we can also do is sort of mitigate the volatility, because as our tagline states, we invest in the journey. Investing in growth equities is always a bit of a journey. It's never a straight line. But with this product, what we've been able to do is compound over 19 years now, compound at about 15% per annum, but do so at a volatility at less than that of the benchmark. And what that means is basically we're giving our clients access to double-digit rates of return on an average basis, net of all fees and expenses, but doing so by mitigating or just smoothing out the journey and investing in growth equities. That's really the key for this product, and therefore we like to call it really investing in growth equities with a little bit of a seatbelt attached. The middle fund, which will be the focus of what we do here, is really the Global Growth Equity Fund. Now that you can think of, as I mentioned earlier, a liquid alternative is long equities, short equities, and some derivatives that we use. This middle fund is simply for clients that want access to our long equity style of investing without any bells or whistles attached. So always fully invested, 20 to 40 of our best global growth ideas anywhere around the world. And this is a relative return mandate. We seek to beat the benchmark and ideally outperform some of our peers. And we're happy to say that this fund is actually in the top 10th percentile of all global equity mandates that have existed in Canada over the last 5 years. Finally, on the far left, and we'll talk about this a little bit more in a second, we are thematic-based investors. We invest in these massive shifts happening in society. For us, one of the biggest trends that you can invest in today, and we think it's the early innings, we would even compare it similar to investing in the advent of the internet back in the early 2000s. That's how big we think this is decarbonizing the planet. Now, this, to be clear, is not just broad-based ESG. It is us following the dollars. In this case, we think almost $50 trillion that will be spent, that is arguably already being spent by governments around the world, by capital markets by way of investors, and by corporations, most importantly, to try to decarbonize the planet. Now, the key here to understand as growth investors is our objective is not to see whether they're successful or not in decarbonizing the planet. It's simply to follow the money that eventually becomes revenue and earnings growth for the companies that can benefit. And so that's what that strategy does. We like this opportunity so much that we, again, when I'll talk about how we layer our thematics within our diversified fund in the middle, but really we thought that this climate change opportunity was too big to keep in one particular fund, to limit it to 20% of our fund, which is a limit for any thematic, that we gave it its own standalone product that is actually Canada's #1 performing climate strategy that just hit its 3-year number yesterday. That's a little bit on the product shelf, and maybe it'll be helpful to just jump into how we look at the world, if that makes sense to you, Mario.
Yeah, it works. So just real quickly, so
Yeah.
Munro out of Australia, just for people listening to the call, obviously the team's been around for a very long time and kind of created this company out of Australia. And then was it around 5 years ago or so? When did they partner with CI? Can you?
Yes. Great question. So in 2018, what really happened was the rules changed around the liquid alternative space. So these products began to be available to retail clients. And CI was really first to market and is the biggest provider of liquid alts, if I'm not mistaken, in Canada. And how they did that was quickly look around the world to understand which of these liquid alt mandates they could do in-house and which of these they needed to simply partner with someone externally to do that already had an existing track record. So you guys are probably familiar with the Merit Asset Management team. They do the fixed income side of things. You can think of us sort of as the equity side of the liquid alt equation. And so in 2018, when the rules changed, CI actually owns a minority stake in our company. The rest of our company, I shouldn't fail to mention, is owned entirely by our employees. So we are a partner-owned firm, a majority-owned firm. The rest of it, a small piece, is owned by CI. And really, they used us to bring that liquid alt to Canada in 2018. And since then, it's had success. And really, in 2019 is when CI realized that maybe we should also be running simply a plain vanilla long-only version of that strategy, which is when that CI Munro Global Growth Equity came to life, if that makes sense.
Perfect. No, that's awesome. That's fantastic. So then, like the philosophy they've have on that Australian mandate flows through to today and the current mandate, obviously here.
That's exactly right. So everything we've done since 2005 is the same team and the same thinking that applies to the strategies we're talking about today. And our Australian and Canadian funds are managed pari passu, so identically, other than, of course, the purchase currency being Canadian dollars versus Australian dollars.
Perfect. Awesome.
Perfect. So let's jump straight into our philosophy. And this is a slide that's existed, really one of the first slides that we ever put together when we created a presentation deck. And I think not only does it tell you how we invest in the world, but it shows you how our way of thinking is slightly different than the market. And I'll try to explain that using these two companies that I think everybody on the call is pretty familiar with, MasterCard on the left and Bank of America on the right. Now, what you're seeing in both charts in the blue line is the share price of each company going back almost 2 decades. In the gray line, what you're looking at is the blended forward earnings per share. So really another way to look at that is on a per share basis, where is the forward looking profitability of each of these businesses? And the reason we plot both of these lines, and what you'll notice in both cases, is that the blue line tracks, or rather the gray line tracks the blue line fairly closely. And that brings me to my main point of this slide. If you're going to take anything away, it's that we have a strong belief that earnings growth drives stock prices. If you can figure out, at least on a medium term view, how profitable or unprofitable a business business is going to be, you can often figure out where the share price is going to go as a result of that. Now, that is true for both companies. But the reason that we spend all of our time looking at the left-hand side scenarios here, not just MasterCard, but many of these other thematics in the world, is for a very specific reason. We see, as you can see, we've labeled that a structural growth company. And the reason for that is you can see that the earnings per share, that gray line, is going up and to the right in a pretty insulated manner. And that's happened with rates going up, rates coming down, different presidents in the White House, different wars happening around the world. Regardless of what's happened over a long period of time with minor bumps in between, that gray line is tracking up and to the right pretty neatly. And as a result, the share price is following up and to the right. So a lot of value has been created in investing in companies like MasterCard and Visa. And the reason that it's able to do that along with Visa is because we are still in that shift, the structural trend that's moving us from physical cash to digital cash. Everybody knows that's happening. Nobody here, I assume, walks around with only cash anymore. Everybody has some form of card payment. But I'll tell you a secret that 1 in every 2 transactions still done around the world, including in some developed markets, is done using physical cash. So as a result, we think Visa and MasterCard, even if some people call them pretty obvious winners, we think that there's a lot of unpriced earnings expectations ahead, and therefore the share price can follow. And that's something that's a structural trend amongst many others that we found a process in trying to identify. And I'll show you how in a second. On the right-hand side, though, we're not saying Bank of America is a bad investment. We leave that to other equity managers or other fund managers within your portfolio, because remember, all we're trying to be is your structural growth equity manager. On the right side, you see Bank of America. The earnings profile is a lot more volatile. It's ebbing and flowing with economic cycles, with various macro factors that maybe some people can predict. We simply don't pretend that we can. That is not where we have our edge. That is not what we try to do for our clients. And ultimately, even if you could predict the earnings of a company that's more cyclical in nature, like Bank of America, ultimately, you're not creating as much value from a capital appreciation or a growth standpoint, as you can see with that blue line sort of following some sort of trend over time. So ultimately, what we're trying to do is find many of these trends happening around the world, like the digital payments trend, but many others that I'll talk about in a second, and then do the bottom-up work to figure out who the few companies are that are going to benefit from that particular trend. And this is really the piece of academic research that I love showing to clients. It really is a reminder, and I think it's especially relevant in a time like today, because everybody's so concerned about the fact that a handful of stocks are driving this market higher, when really the other 492 or whatever you want to call them are having a tougher time following their larger cap counterparts. But I just want to point out that over the course of the US stock market, that's literally what's been happening. And so what this study done, and this is done by an economist by the name of Hendrik Bessenbinder, happy to share his research in more detail after the call for anyone that's interested. But basically what he figured out, or what he wanted to know, was that is there any value in actually investing in equities? Right? So is it any value in buying equities or investing in the stock market over just owning some sort of GIC or money market type of product? In this case, he used a treasury bill in the US. And what he figured out is basically what he did was he plotted almost 26,500 companies over a 90-year period. So from the inception of the US stock market all the way till about 2017. And what his results were actually really eye-opening for a lot of people, because what he figured out was that just 1,000 companies, so 4%, roughly speaking, of all statistical observations were responsible for creating all of the wealth created in the US stock market over and above T-bills. And then he figured out that just 0.2% of all statistical observations, or about 50 companies, were actually responsible for 40% of the total wealth created in the US stock market. So what we did on the right-hand side here is we plotted some of those companies, and we came to the realization that what we came up with a couple decades ago in finding structural growth champions was actually validated, because you see here on the right-hand side many household names. They might be household names today, but at one point they were early stage companies capitalizing on various structural trends. So when big box retail came around, Home Depot came to light. When fast food became a thing, McDonald's came to light. When, again, that digital payments trend with Visa and MasterCard, social media brought Facebook to light. I can keep going on and on. But the point I'm trying to make here is that whenever there's a change in the way consumers interact with the world, there are definitely some companies that come around that try to capitalize from those trends and grow their earnings as a result. So that's all this slide is trying to make the point of, is that in the long run, it's better to have a very focused investment process that's repeatable and able to find the handful of companies that are worth investing in that'll actually generate wealth and actually create value for our clients. This process, there's a lot of moving pieces here. I won't bother going through each little thing. Happy to tackle that in the Q&A, other than to say that first, we start with that big giant subset of, or really that universe of companies that represent the global equity market. We then narrow down by one level by looking at companies that are actually growing their earnings. Companies that are growing their earnings in any capacity. And then we narrow it down one level further, as you can see on the far left, into companies that are growing their earnings on the back of some sort of structural shift. And that creates what we like to call about 1,100 securities within our investment universe that we bucket into areas of interest. And I'll tell you about that in a second and why we do that in a second. To qualify as one of those structural champions, you have to rank highly in step 2, which is our qualitative 6-step test. Again, won't dive into too much detail there unless there's questions in the Q&A. And then it's all great finding the top-down winners, but then you need to prove the maths to yourself. You need to basically answer one key question for us by way of us modeling out your earnings growth. Is that, number one, do we have a differentiated view on a company's earnings growth versus the market? And number two, does that differentiated view show us that your earnings per share can double in 3 to 5 years? Because guess what? If your earnings per share can double in 3 to 5 years, your share price will often do the same thing, barring any left field events. And so that's really how you get into our 20 to 40 stock portfolio. And then after that, again, for clients that may not want as much volatility as the next growth fund, we have a stop loss process in place. It's all good finding your winners, but the key, and as you can see on the right-hand side, our biggest contributors over time to our Canadian track record are much bigger in size than our top 10 detractors. And that's because any stock that falls 20% from its peak or its cost is subject to a formal review, not automatically sold, but we ultimately, the stock champion responsible for that position, will go back and basically try to understand whether the sell-off in the position is down to some sort of sentiment or positional rotating within the market, in other words, not really related to the fundamentals of the company, or if there's something that he or she has missed. Even if they believe that that position should be kept in the fund and that it'll eventually come up from that 20% drawdown, they still have to go and repitch that investment case to the entire investment committee. And in that way, we think we remove some of the emotional biases that naturally come along when you're investing in early stage growth companies. And we're proud to say that over our Canadian journey, we've never actually had a single position detract more than 100 basis points from our total Canadian track record, which I think is pretty impressive from a growth equity standpoint, given how volatile some of these equities can be. And that's really everything I'll say on the actual process and how we run money, Mario.
Perfect. That's awesome. And so I'm assuming now we'll maybe step into a couple of ideas, some of the kind of positions you've looked at, maybe dig a bit deeper on that side if we can.
Absolutely. So let's take a look at what our top 6 bets are today. And to do that, we always like to show this slide. Again, we look at areas of interest so that we don't confuse what actually drives a company. In the case of MasterCard and Bank of America, the market actually calls those two companies two financial businesses. So it actually puts them in the same sector, even though, as we showed before, they're not actually driving their earnings using similar factors. So in the way that we layer our portfolio, our thematic-based approach allows us to only look at companies in a similar manner if their earnings are being driven by similar factors. And so we have over 20 of these areas of interest that we can toggle between depending on the market conditions. Right now, there's about 10 or 11 of these bets within the fund. These are our top 6 on the screen for you here. Number one, simply put, and we're going to dive into this in a bit, so I won't spend too much time, is the hardware side of enabling artificial intelligence. And that is called high performance computing. Yes, NVIDIA is our biggest position there, a name that we've owned for 6 or 7 years. And really, but as you can see there, the number of positions in that bucket should tell you that this is not just an NVIDIA story. We will remind you using a few pieces of evidence in a minute or two that NVIDIA is just the architect of these highly complex chips ultimately. And those chips, and now they're actually doing a whole bunch of other things, but when you look at their crown jewel, their GPU, a whole bunch of other companies in that supply chain are responsible for bringing that design to life. And so we're betting on that entire supply chain in many businesses that we think are underappreciated by the market. Digital enterprise, here we're looking at the other side of the equation because all of this hardware is being built in terms of semiconductors to power better software. And so digital enterprise is simply us looking at businesses that are ultimately enabling and adopting artificial intelligence from a software standpoint. And we'll show you some cool videos and some demos within our slide deck that show you some of these early opportunities that we're looking at. Climate change, we talked about it earlier. As I mentioned, we have a standalone product for it, but it can also be up to 20% of our global equity fund here that we're showing you today. It's just over 10% of the fund. Again, this is us following the E within ESG. We're not just investing in companies with good social or governance scores. We're investing in companies that are actually going to make better earnings and better revenue growth as a result of providing some form of carbon solution to the world. Connectivity. This is really us looking at companies that were once responsible for building the technology and infrastructure to take 5G to networks down to consumer devices that we now all have access to on our phones and our laptops. And now those same companies are being asked to take AI from the data center level, from the cloud level, to down to everyday devices, so that everybody on this call and everybody around the world can actually interact with AI applications and ultimately make their lives a little bit easier. We'll talk about that in a second. Digital payments, we covered this already. This is really that shift from physical to digital cash. Today, we've added a nice small cap company in the UK called Wise, which is really solving a multi-trillion-dollar problem in cross-border payments. We can talk about that if you like in the Q&A. And then e-commerce, fairly intuitive area of interest, really taking away from brick and mortar retailers. And today for us, this is a one stock story, and that's Amazon, because what people don't realize is for a number of years, the world's biggest e-commerce business in Amazon has actually been unprofitable. And this is the year we think they come back to profitability. And so this is a great time to own this company, we think.
Perfect.
With that being said, yeah, sorry, I'll pass it back to you, Mario.
No, that's good. Actually, it looks like we're getting right into it. Yeah, the main thing we're curious to dig a bit more was the AI side. So it seems like we got that teed up. So that'd be perfect.
Awesome. Let's dive straight into it. So as I mentioned, what we're really going to talk about are these first two bars here, the high performance computing and the digital enterprise, what we like to call the hardware and software side of enabling and adopting artificial intelligence. And this slide here, I'll step back, and before we even talk about AI, this is how we make sure that we're not losing unnecessary capital for our clients, even when we're investing in long equities, because we follow the playbook that you're seeing on the right side of this slide. With any thematic we invest in, if you think about the gold rush of many, many years ago, the successful investment strategy that we now use for any thematic that we look at is to first invest in the companies providing picks and shovels in the boom. The companies that are going to win regardless of who the end gold companies are that are successful in finding that gold, and that are basically hedged because all they're doing is providing the foundation for that particular trend. And then slowly and steadily investing in the top layer, the companies that are going to take that foundation and go and find the metaphorical gold. In this scenario, looking at AI application companies that are coming to light here. And so when we use that playbook and tried to look at AI really 5 or 6 years ago, we realized three things very clearly. We had no idea, and arguably I could still make this point today, we had no idea who the clear application winners were going to be. We knew that, and we still know that companies like BMW and Mercedes are going to build AI interfaces within their cars, but I can't tell you who the winner is going to be, who's going to have the better interface. We know that Pizza Hut and Domino's are going to have some form of AI generated chatbot that helps facilitate orders, but I couldn't tell you who that winner is going to be. We'll see those coming out, and we'll invest in those as the data becomes more clear in the adoption. But we knew two things very clearly, and that's the two bars at the bottom there. And what that was that every AI application, number one, needed to be trained at the data center or trained in the cloud, because these are very complex data sets. If you think about what AI is, it's simply taking all of the information that's being collected around us, that's already been collected around us for many years now. Think about YouTube and Netflix making better recommendations for you. That was literally a simple form of AI. But now with the semiconductor capacity that's possible, these data sets are being trained in a much more rigorous manner at the data center level. Three companies own that entire data center market, more or less, and that's Microsoft, Amazon, and Google. So these are what we call own it, don't trade it. Then we realized at the bottom, semiconductors at the bottom, we realized that a handful of these companies, not any old semiconductor business, but a few key monopoly businesses, were going to take all of the market share when it came to creating these much more advanced semiconductor chips, the chips specifically geared for AI purposes and what we call high performance chips. And so we, at the time, immediately started to like businesses like NVIDIA, but also the manufacturers of NVIDIA's chips like TSMC and the companies that provide the massive pieces of equipment that TSMC uses, like ASML, a Dutch company that really has market share in what we call lithography. And now we're excited because slowly, Mario, we're able to move into the top layers. We're seeing some of these great application providers and software companies making their clients' life easier with a slightly higher price version of their existing offerings. And let's talk about a few. So when you're looking at the AI playbook, specifically around software, we have to recognize that while AI is brand new, this playbook has been around for decades, and that's the iPhone playbook. AI is just having its iPhone moment. So let's take you back to the early 2000s when Apple came around with this piece of hardware called an iPhone. And all of a sudden, this company that was trading at about 10 times forward PE, that's the valuation metric, that went all the way by the time it sold 2 billion iPhones, was trading now at around 28 to 30 times. And they didn't justify that huge valuation premium by just being a hardware company. They sold these little black boxes that had the internet directly in your pocket that everybody could have access to on the go, and paved the way for a bunch of great application companies. Think about Uber, think about Tinder, think about Spotify, think about Snapchat. All of these companies that are really unrelated to the iPhone story or the Apple story, at least on as far as the company is concerned, and are now monetizing the fact that you have access to the internet, whether it's through advertising revenue or whether it's through a monthly subscription model that you as the consumer will pay. And all of these applications are almost taken for granted because of how much easier they make our lives on a day-to-day basis. The same thing is happening on the AI side. We have what are called large language models. That's a fancy word for highly complex data sets that have hundreds of millions of parameters within them, that are really just data points that are collected from consumers in different angles. And those large language models are now trained and available on the shelf, made available by companies like OpenAI, like Anthropic, and a couple of others. And now you have these great software businesses that are going to take those large language models, plug them into their existing software offerings, and make their consumers' lives easier. And I can talk about them, or I can show you a few cool examples. So what you're seeing happen live in front of you is Microsoft's Copilot. And in this case, it's literally taking a Word document that was received through email. You're telling the Copilot to create a deck for you. And in seconds, you're literally creating at least the early structure of a PowerPoint presentation. Now think about everybody in this call. I'm sure I'd like to bet at least that everybody's using some form of Office 365, and think about how much easier your lives become if you can literally talk to a little AI assistant that can turn a proposal received through email into a PowerPoint or vice versa, or summarize a PDF as you receive it through email. All of these little tasks that we do, dozens of throughout the week, can become made easier, where we just have to go in and clean things up afterwards. And that's the Copilot function. And this is why we like Microsoft here, is because as we showed you earlier, Microsoft is the second biggest cloud provider. So it provides the foundation, but also, as you can see in this slide, it's also providing an application. So it's double dipping as far as the AI story is concerned. Let's talk about another cool example. So Adobe, this is a company that many people are probably familiar with for its Photoshop or for its document management function. Now, if you gave me, this is what we call Adobe Firefly, and what that is basically an AI-powered version of its Photoshop. Now, if you gave me these 4 images and basically asked me to, if you gave me Photoshop, Mario, and said, hey, here's a series of images, please change them to ones with a summer backdrop with a lake running through the middle, and maybe put some flowers into the foreground to make it pretty, you could leave me there for days at a time and I'd have no idea what to do. But now I don't actually need to know what to do. And the reason for that is I can do this. I can literally enter in this chat box below the instructions I just talked about. And as I'm telling the application to do it, you see that the images are being edited live for you. Now think about what that does in terms of actually not having to go and hire a digital media coordinator or somebody with the skills to do this on Photoshop, or having to, God forbid, learn how to do this myself. So think about how many of these individual tasks are going to be made more simple from this Firefly adoption. Let's talk about another story here. This is a fun one called Pinterest. Now, I'm sure everybody here is at least familiar with the concept of Pinterest. This is basically a media platform. Really think of it as like the original Instagram, where you could post ideas all day long for free and go steal inspiration for everything from your next house remodeling to the next outfit you wear on a vacation and everything in between. Now, the problem with Pinterest and many other advertising businesses that relied on advertising revenue in 2021, advertisers decided to scale back their budgets. And when they eventually decided to come back and start to spend money again on various platforms, they realized that Pinterest, although it has 500 million monthly active users, the problem, unfortunately, was that it wasn't as shoppable as advertisers wanted to be. What I mean is, if you look at this slide here, you know, some products are pretty intuitive, but even if you knew exactly what the product is that you wanted, you'd have to go externally to make that purchase. So it's not as lucrative to the advertisers as they wanted it to be. But now, what they did and what they really copied Facebook in doing is they bought a bunch of NVIDIA's GPUs, and we're going to talk about what those are in a second. They trained their own large language model. They plugged that model into Google image search, and now what you can do here, in this case, you can search, you know, we're going to use a great example here of George Clooney holidaying out in Italy. So you can search George Clooney Italian fashion. You can pick an image. And as you can see, the large language model is searching and finding links to directly purchase those items for you directly on the site. And so this is another cool way that we think AI is already changing people's lives today. Now, I don't recommend this. This is a very expensive shopping trip done in a matter of seconds, but for the intentions of this presentation, we thought it'd be a cool way to demonstrate how a company like Pinterest is now become much more shoppable and therefore much more attractive to its end clients or to the users on its platform. One more example here, right? So we all know the story of having to watch, you know, some sort of, in this case, we're talking about an earnings call, but to watch an entire 45 or 1 hour long video only to take away one or two things that we wanted to know in the first place. But it's hard to know where those points are going to be in the video, so you end up having to watch the whole thing. So in this case, our CIO, Nick Griffin, what he wanted to know, one question about Netflix's latest earnings call, and that was, why did Netflix invest in WWE? Instead of having to watch a 40-minute video of the management team talking about it and talking about a whole bunch of other things that maybe aren't as relevant to us, he did this. He popped that YouTube link, he opened up the YouTube video, took that YouTube link directly from the website, went on to Google Bard, which is basically Google's version of ChatGPT. We personally think it's a better version of it because of the large language model is better. And as you can see, he's specifically asking it, why did Netflix invest in WWE? And within seconds, Google Bard is watching this YouTube video and coming up with the specific answers to your questions. Now think about how many hours that's going to save out of his day, our entire investment team's day, and millions of people around the world that can already use this feature. And so these are just a few ways that we thought would be relevant to share with you and make the point that AI, while it's going to be a multi-decade build out and we haven't even started to see all of the different industries that it's going to benefit, there are already early adoptions today. And we're trying to invest carefully in the companies that are going to be just fine with or without AI. That's the trick here, but are also going to give you that free additional upside if their AI strategy is also successful. But with all this great software, you can't have any of it without a great hardware cycle behind it. So as we talked about before, our biggest bet is the high performance computing and connectivity buckets, which really focus on the semiconductor industry. And as I promised you earlier, as you can see here, the layers underneath that bucket show you that this is not just an NVIDIA story. And we'll tell you why in a second. Let's take a 10,000-foot view though. Basically what you're looking at here is over 50 years since the beginning of the semiconductor industry. Now, what I'll make clear is that there's an inflection happening. Remember, we don't really like investing in cyclical businesses. We like structurally growing areas of the market. And we would argue that the semiconductor space, has gone from a cyclical industry to a structural one. And that's being demonstrated by this blue line on the screen, which is starting to exponentially grow faster. And the reason for that is because the customers of these chips are changing. They're going from these very economically sensitive industries, manufacturing plants, automotive industries, and things of that nature, to now being big tech companies that can't get enough of this accelerated computing power. And therefore, while it's taken 50 years to generate $500 billion of revenue or value in this industry, the next $500 billion is already starting to be created and should only take 10 years to generate that next 500. And that's because of this inflection. And the other thing we'll make clear in this slide is that it's not a surprise to us. In fact, all the way back in 2021, we did make the claim that NVIDIA would be the biggest company in the world. And although it happened for a brief second, we did see that happen finally a couple of weeks ago. But it's happened before. In each of the phases of computing, the biggest companies in the world arise. So when computers were first made, we called them mainframes. They basically look like big, scary server rooms. And IBM became the biggest company in the world. Semiconductors got smaller. They stuck them into what were called personal computers and put them directly in your homes. And Microsoft came around as the biggest company in the world. Then we looked at a company like Apple because semiconductors got smaller. They went into smartphones, and Apple became the biggest company in the world. That was the third era, the mobility era. AI is just the fourth era of this massive computing innovation era. And so, really, it makes sense to us that NVIDIA and a couple of other companies that we'll talk about are becoming exponentially bigger in size and importance to the world. And this is why. We're basically seeing NVIDIA take us from a world of linear computing on the left-hand side. So basically computing basically used to be input output. So that was driven by a CPU making singular decisions one at a time. And now those CPUs are working together with what are called GPUs or graphics processing units. And that is where NVIDIA comes in, because together we get what's called parallel processing, where those GPUs are making thousands of little decisions alongside the CPU that's making those larger decisions. And together you get computing power, which is 100 times faster. At NVIDIA, not only does it give you the best in class GPU that all of these big tech companies can't get enough of, but it's now also going into its iPhone moment. It's having that software inflection by providing the software that you need to program that particular chip. And this is why we think they're going from what was once a gaming company that sold chips to PS4s and Xboxes to now a chip company, and now into the future, a one-stop shop for anything you need at the data center level for AI purposes. This is how they're monetizing it. Not to get into too much of the detail, but the world's data centers, this is where the critical IP or digital footprint of corporations around the world are stored. There's already been a big shift into the cloud even before AI, and that's being accelerated because of AI. And ultimately, data centers are going to double from where they are today, about $1 trillion worth of them, to 2 trillion by the end of the decade. There's a big problem though, because only 14% of the world's data centers are equipped or retrofitted with that parallel processing capability I talked about. And really, we think that penetration gets to 45% by the end of the decade, which basically turns into almost a $500 billion recurring revenue opportunity for the companies that can facilitate that retrofitting or that retooling of the world's data centers. And no surprise, you see on the right-hand side of this slide, guess who has 85 to 90% of that market share? And that, of course, is NVIDIA. But again, we'll talk about where the story evolves beyond NVIDIA, because what NVIDIA is doing is great for the data center level, but we still need to go below into what we call the bulk of the iceberg, which is basically bringing AI capabilities from the data center, from the cloud, all the way down to end devices, into everything from how you use your phone, how you drive your car to work, what you do when you go to the hospital, the various equipment in there, and even some of the smart cameras that you put in your homes, and really hundreds of other industries around the world that need to be able to run AI models directly on the device. And this is where our team is now investing in what's called AI to the edge. This is the problem with doing that, is because on the left-hand side, you're seeing the chip that's powering this very computer I'm using, that's powering a lot of the technology that many people use today. That's a general purpose chip. It's fairly cheap. It's about a couple $100. You can scale it pretty widely. And ultimately, it's small in size. It's 38 millimeters, as you can see. But it doesn't have anywhere near the computing power you need to run an AI model directly on your phone. Just won't work. On the right-hand side, you see this big transformer-looking thing. This is NVIDIA's crown jewel. This is the GPU that is well out of stock today, called the H100. And as you can see, well, it's 500 millimeters in size, and by the way, will cost you 26.5 grand US dollars. Good luck trying to put that into an everyday smartphone or a laptop. And so this is where we're going next with the semiconductor industry. I'm showing you on this slide that same chip, just on a side-on view. And what you're seeing, I won't go into the intricacies of all the engineering that's going on here, happy to do so really in the Q&A. But as you can see here, NVIDIA is just the architect. It's providing the logic or the brains of this operation and designing this entire contraption you're looking at, but you need a lot of other small and mid-cap companies around the world to really bring this design to life. The easiest way I can explain it to you, and one investor actually did this, believe it or not, back in 2007, is when that first iPhone came out. Instead of showing it off to his friends and family, he took that iPhone home, he took a hammer to it and smashed it open. And what he realized when he did that was that if Apple was going to be the winner in the smartphone race, which we know today, I think it's safe to say they are, it wasn't going to be Apple alone that was going to make him a lot of money. It was going to be all the hidden heroes inside that were going to play a crucial role in bringing these smartphones to life. It was companies like Qualcomm and TSMC and Micron and a dozen other companies that provide critical components to that broader smartphone market. We're trying to do the same thing for our clients when you look at the modern day GPU or the modern day chip today. And that's what that's the approach we're taking to continue to be forward looking in this space. I'll talk to you about one more area that might not seem like an AI story, but I promise it is. Longer term, we think that there are so many ways to invest in climate change, but today I'll tell you specifically about where this climate change story starts to converge with AI on its own. Because, and to do that, I'll give you a few stats. US power demand has basically been flat for the better part of 2 decades. But going out till 2030, what we started to see is research that proves that US power demand is going to increase by an average rate of 3% out to the end of the decade. Now that's significant. And so what we did as growth investors, being curious on our own right, tried to look under the hood to see what's driving that. And no surprise, it's the world's data centers. It's companies like Amazon and Facebook and Microsoft and Google trying to build more and more of these data centers, specifically in the US. That's where the majority of the world's data centers are located, to really try to get ahead of this AI curve, because all of these software companies are migrating to the cloud and they need more of that cloud. They need more data centers. Now, there's a couple problems with how they're doing that, because data centers already today represent about 2% of total power demand in the US, and that's going to go up to 10% of total power demand. That's a big problem if you think about how fragile that US power grid is already. That's the first problem. The second problem they have is that all of these companies that I named have conveniently signed up, or the majority of them have signed up for net zero targets. They want to be carbon free by a certain point in time. So now they can't just go back to coal and dirtier sources of energy, but they also need something that runs all day long, because you can't wait for the wind to blow or for the sun to shine to run these data centers. They need to be running 24/7. And this is why we've made a pretty big bet on nuclear energy. And so our player of choice here is Constellation Energy, because what you may have seen in the news a couple months ago is a company like Amazon pairing up with a company called Talon Energy. And we thought that was interesting. And what Amazon is doing, remember, Amazon's the biggest provider of cloud networks in the world by revenue, and they're literally taking their data centers, picking them up and co-locating them with nuclear power plants and plugging them in directly to those power plants in a strategy called behind the meter. That does a couple of things. It gives you a carbon-free source of power, because remember, nuclear has the same amount of carbon emissions as wind and solar, but it can run all day long, unlike wind and solar. And it also allows you to bypass the US grid. So it keeps everybody happy. And we think the next company to announce a deal like that is Constellation Energy, that you can see on the top of this slide, the biggest provider of nuclear power in the US. And this goes beyond that. The same way we broke open the chip to show you all the supply chain providers, we're doing the same thing at the data center level here. What I mean by that is we're investing in companies like Vertiv, for example, a company that many of you may not have heard of, but it's a stock that's up 140% year to date. And the reason for that is it's providing thermal cooling or liquid cooling solutions, because these chips are running so quickly that they can no longer just be cooled by regular fans as they used to. So now not only do they do the liquid cooling for NVIDIA's chips, for example, but they do it for the whole data center. They also need companies like Schneider Electric that actually connect various sources of power. So they do the electrical equipment that connects these sources of power to the actual data center. You need to insulate this data center in an energy efficient manner. That's where we like a company called Kingspan out in Ireland. You then need to do the HVAC in an energy efficient manner, which comes from companies like Comfort Systems that we like here, a small cap company. I can keep going on, but really the moral of this story is that investing in structural growth is not just investing in technology, and investing in AI actually has a big physical and really infrastructure-based component to it that our team, because we have that expertise in the climate change space, has been able to invest in successfully, which is why our climate strategy is actually the #1 global equity fund in the country on a 1-year basis. And with that, maybe I'll pass it back to you, Mario, for any follow-up questions.
No, I think that's perfect. If anyone has any questions, they can submit it via the chat or unmute themselves. Maybe we'll dig into the performance in a moment there. So then looking at all these positions, would you say all these names are currently in the portfolio at the moment, or is it just of these names, how many of these would be in the portfolio at this point in time?
Of the names on this particular slide, you
Yeah.
mean? Yeah,
Yeah.
so on this particular slide, we've got about, I'd say one, two, three, about five of these names are in the portfolio today. We're still trying to figure out Schneider Electric because it is a French company and we all know what's happening in France at the moment. So it's getting punished a little bit unnecessarily. And so we might be looking to make some changes there. We've also trimmed Vertiv significantly just because of how well it's done and it's reached its price target. So again, just a reminder that we do have processes in place to make sure that we're actively managing the portfolio. And even if we like an idea on the long term or on a 3 to 5 year view, if it reaches its 12-month price target, so every quarter we build a 12-month price target and a 5-year price target. And even if the 5-year price target has plenty of room to run in respect for the clients that we're running money for, if the 12-month price target is telling us to trim or sell completely, we'll listen to that signal as well.
Okay, so you probably expect a little bit higher turnover than a traditional buy and hold portfolio. Because yes, these are positions you want to hold for a long time, but along the ride, you're going to liquidate some of it if they kind of achieve their targets a bit earlier, or they get ahead of themselves a bit, and then get back in if there's a pullback in a sense.
That makes a lot of sense. Yeah, that's a good way to describe it. Really, the small price that people have to pay for the lower volatility that we offer our clients compared to other growth strategies is that you do have a little bit more turnover within this portfolio. But again, that overall, we think that that's in the best interest of the client.
Perfect. And then obviously newer mandate to retail clients in this past year, but you had mentioned that they've been working with CI for some time, had an institutional version. So you have some data on the returns, what it's looked like the last few years? Or?
Absolutely. So what we can show you is these are our three strategies performing really over their full track record. As you mentioned, Mario, this middle fund here that we spent a lot of time talking about, this is the Munro Global Growth Equity Fund. The Series F actually does have almost a 4-year number, but the Series I, which was again an institutional share class, that's been around for over 5 years. And over 5 years, we're pleased to say this is actually the #1 medium risk rated global equity fund in the country over the last 5 years, compounding just shy of 20% per annum, but doing so at a lower volatility than some of the other growth players in the space there, as you can see in the middle. And then the climate fund that we talked about is at the bottom. We're pleased to say that since we've reflected a bit more of a positive view on markets after coming out of a pretty volatile period, now that we think that the whole macro story is largely behind us and markets are going to go back to following earnings growth and structural earnings growth at that, as you can see on a 1-year basis, all of our strategies, including our more conservative liquid alternative, are up north of 36%. In the case of our long only fund, almost up 50% on a 1-year basis. But again, that's not to say that you've missed the train here. We still see this as year 1 or 2 of a long and plentiful bull market ahead.
And any kind of short-term concerns you're keeping an eye out for, or anything of that nature, or?
Yeah, that's a great question. So what we are doing a little bit, as I mentioned, we're taking a look at where we're seeing 12-month price targets being hit. And when we're selling some of that, as you know, the long only fund has to be fully invested with the exception of about 10% cash. We're actually buying a lot of names that are geared towards the election. So we've got some great slides that we can share for you afterwards in another presentation, but we're looking at where there's bipartisan support because people would be surprised, I think, at how really similar both Trump and Biden's policies are outside of probably some renewables and electric vehicles that Trump will probably kill immediately. Other than that, there's a lot of similarities between their approaches. And so we're trying to position both in the climate space and on the infrastructure side of the equation, even some names on the technology side that should benefit as well. We're looking to reposition the portfolio on a short-term view to really make sure that we're managing some risks around the elections around the world, with the US election being a key one. But after that, in 2025 and beyond, we do see that bull market returning to business as usual, if you like.
Perfect. No, sounds good. We have a bit of a quieter chat today, but if people do have questions, they can always reach out to Mark, Cliff, or myself. We'll be more than capable to answer most of them, or if it's something that's a bit too complicated or needs a bit more data, we'll just reach out to yourself to kind of pull on some of that info. Anything you think we might have missed that you'd want to touch on, I guess, before we wrap it up? Obviously, the climate leaders there, so.
Yeah, absolutely. I think, look, I think we've done a good job of covering what we do as far as a money manager, but I want to reiterate, while today's presentation was on AI, we have a lot of uncorrelated bets within the fund. We can invest in things, one of my favorite stocks right now is Chipotle. It's been a fun fact, it's actually a stock that's outperformed Apple over the last 5 years. And so we're looking at areas that are less correlated to each other within that structural thematic portfolio, and we can invest in the middle income consumer. That's where we look at everything from On Running or Shark Ninja and Chipotle to healthcare bets. We've been big proponents of the diabetes and obesity opportunity with Novo Nordisk and Eli Lilly. We actually caught on to that a little bit earlier than the rest of the market. And of course, with our climate change bet, we're investing in utilities and industrial-based companies. All of these are really uncorrelated to the bigger tech sector, even though we're big proponents of AI today. So I think what I would leave with the audience here is that in terms of how we run money, is we can give you that upside you're looking for without necessarily the volatility that comes with it, thanks to that diversified approach that we take to growth, as well as that stop loss process. The one last slide here I'll leave with you is that everything I've talked about today, in some shape or form, we have a great YouTube channel with some nice videos that we spend a lot of time and money on with our team in Australia, recording their views on investing in AI and other cool thematics. We've got podcasts around the same thing. We've just released a podcast on NVIDIA, and we've got a great website with a lot of good information. So this QR code on the far right here, if anybody wants to take a picture of it, we can also circulate it afterwards, gives you a list of resources pertaining to Munro. So I'll leave it there.
That's perfect. Any final words, Cliff, by chance you want to chime in on, or?
No, it's great information. I think it takes a much broader look at some headlines that people see. You just hear about AI and technology, NVIDIA. You see these names, but knowing that there's a lot more to the space and the value that your firm can bring clients. It's great to have that information. I really appreciate the time you've taken to share that with us today.
Absolutely. Thank you for having me.
Awesome. Thank you so much. Everyone take care. And as always, just reach out to Cliff, Mark, or myself for any questions. And have an outstanding day. Bye for now.
Thanks, Mario. Take care.